In 6 hours, Microsoft just watched more than $300 billion evaporate from its market value. And it wasn't because the quarter was bad. It was the opposite. They came in above expectations. Revenue printed $81.3 billion versus $80.3 billion expected. Earnings per share landed at $4.14 versus the $3.91 consensus. Azure, the growth engine everyone obsesses over, was up 39% year over year. In any normal universe, that's a good news day. But the market treated it like a warning siren. The stock dropped roughly 12%, and by the time the session was done, over $300 billion had been wiped out in about 6 hours. That's the kind of damage you expect from a scandal, not from a company that just beat the numbers. So here's the question that matters. How do you deliver a quarter that beats expectations and still get punished like you missed? How does a report that looks like a win on paper turn into a sell-off this violent in real time? Here's what I'm going to do. I'm going to break down why this move happened, step by step, and why it made perfect sense to the people who control the most capital. Because this isn't really a Microsoft story. It's a story about the AI infrastructure race and what happens when companies spend like the future is guaranteed, but the market decides it wants proof now. The market doesn't reward what you just did. It rewards what it believes you're going to do next. And when expectations get stretched far enough, the companies writing the biggest checks today can end up taking the most brutal hit when reality shows up later. Quick side note before we go deeper. I put together a free early retirement calculator because a lot of the FIR calculators online are built on assumptions that don't hold up once you run the real math. Mine uses the same framework institutions like Vanguard and BlackRock use to stress test plans, so it shows you where your strategy breaks before life does. If you want it, it's free. I just ask for an email so I can send you the report. I don't save your financial info. It's linked in the description. Think of it like a high-stakes poker table. You've been pushing chips into the pot all night. Big raises, no hesitation. Everyone around the table starts to assume the same thing. This guy must be holding something real because nobody bets that aggressively without a reason. Then the hand ends, you flip the cards, and sure enough, it's a winner. Strong, clean, the kind of hand that usually shuts the room up. But instead of everyone reacting with fear, they stand up. They don't leave because you were weak, they leave because you've already committed so much capital that a single win isn't enough anymore. From this point forward, your future hands don't just need to be good, they need to be better than good over and over, just to justify the scale of what you've already put on the table. That's Microsoft right now. Now let's slow down and look at what actually came out of the report, because the summary most people hear is basically useless. Microsoft reported $81.3 billion in revenue for the quarter, up 17% year over year. That's not fine. That's strong for a company this size. Their intelligent cloud segment, which is where the market is laser-focused, came in around $32.9 billion, up 29% year over year. And Azure, the headline driver inside that segment, grew 39%. If you stop there, the conclusion is simple. Microsoft had a great quarter. Most companies would do anything to print those numbers. So why did the stock get treated like it blew up? Because markets aren't paying for what those numbers were. They're paying for what those numbers imply next. And the part that triggered the sell-off isn't on the front page. It's in the details investors actually price. Here's the first crack in the story. Azure grew 39%. That sounds amazing until you put it next to what came before it. The quarter before, Azure grew 42%, and before that, it was lower, which means what investors saw wasn't growth. They saw a curve starting to bend. And this is the part most people miss. The market doesn't price the number, it prices the direction of the number. It's not asking, are you growing? It's asking, are you growing faster than you were? Because that's what supports a premium valuation.
When a stock is trading around 30 times earnings, you're not being valued like a mature company. You're being valued like a company that's supposed to keep surprising the upside. So the moment that growth rate starts to cool, even slightly, it changes the entire equation. In this game, the level matters, but the slope matters more. And then came the line that mattered more than any headline number. Management basically said demand is strong, especially for AI, but the bottleneck isn't customers, it's capacity. They're telling you the constraints extend through at least June 2026. Now, in plain English, that means we could sell more, but we physically can't deliver more fast enough. And that sounds like a good problem until you realize what it does to the stock.
It puts a ceiling on near-term upside, because if you're already running into limits on supply, then the next few quarters might not be about explosive growth, they might be about waiting. And markets hate one thing more than bad news: uncertain upside. When investors can't see how the company breaks higher in the short term, they don't pay peak multiples for it. Now we get to the number that actually spooked the people moving real size: capital expenditures. Microsoft's capex this fiscal year came in around $37.5 billion, up roughly 66% year over year. Let that sink in. This isn't a little more investment. This is a company stepping on the gas so hard the floorboard snaps. To understand how extreme that is, you need context. Not that long ago, Microsoft's entire annual revenue was in the same neighborhood as what they're now pouring into infrastructure over a short window. This is not normal for a mature tech giant. This is wartime spending. And here's why capex matters more than the earnings beat. Capex doesn't punch you in the face on the income statement right away. It gets spread out over time, so reported earnings can look healthy, even while the company is writing massive checks. But cash is different. Cash leaves immediately, which means what gets hit isn't the pretty number in the press release, it's free cash flow, the thing that actually determines how much money a business can return to shareholders without borrowing or financial gymnastics. Here's the simple math. Microsoft generated about $28.7 billion in operating cash flow last quarter, strong, but they spent around $11.4 billion of that on capex in the same period. So before investors see buybacks, before dividends, before anything that feels like shareholder return, a huge portion of the cash is already gone, locked into data centers, chips, and infrastructure. And once you see that, the story changes. Earnings can look great while cash gets squeezed. And cash is the number institutions care about, because cash is what pays for everything. And there's another layer here that makes investors even more cautious. Traditional cloud computing is a beautiful business. You sell generic compute, storage, networking, and because the infrastructure gets reused across millions of workloads, the margins can be fantastic. Once the machine is built, you're renting it out over and over. AI is different. AI training and inference are far more hardware intensive, and the hardware isn't cheap. You're dealing with top-end GPUs that can cost tens of thousands of dollars each. And the worst part isn't just the price, it's the shelf life. In traditional cloud, your infrastructure can stay relevant for years. In AI, the underlying chips and architectures evolve so fast that what's state-of-the-art today can feel outdated way sooner than investors are used to modeling. So even if demand is exploding, it doesn't automatically translate into the kind of margin profile people associate with cloud. That's the tension. More customers begging for AI compute sounds like upside, but if the cost base is rising and the equipment refresh cycle is brutal, the returns can end up looking a lot less magical than the headlines suggest. And when you're spending at this scale, margins aren't a detail. Margins are the whole game. Now put yourself in the seat that actually matters in moments like this. You're a fund manager running a big book. Microsoft isn't a cute position for you. It's a core holding. Maybe it's oversized because it's been working, because it's liquid, because it's the kind of name you can hide behind if anyone asks questions. Then earnings drop.
You've got maybe 90 seconds before after-hours pricing starts running away from you, and you process the same three signals at the same time. First, the growth engine is still strong, but the trajectory is cooling. Second, spending is accelerating. Capex is exploding, which means cash flow gets tighter. Third, the valuation is already rich. The stock is priced like it deserves perfect execution. So your brain doesn't go to, did they beat revenue? Your brain goes to, what happens to the multiple? Because if the market decides Microsoft shouldn't trade at 30 times earnings anymore, if it gets repriced to 27, that's roughly a 10% hit just for multiple compression. And a 10% drawdown on an oversized position isn't volatility, it's career risk. So your risk system does what it's designed to do. It screams, cut exposure. You sell some shares after hours, not because you think Microsoft is broken, but because the math just shifted against you and you can't afford to be the last one to react. And you're not alone. Every other institution watching the same print runs the same calculation. That's how you get a stampede. Not because the business collapsed, but because the pricing assumptions did. And the part that should make you uncomfortable is this. Microsoft isn't unique. This is the same setup across the entire mega-cap complex. Google, Amazon, Meta, even the companies that look untouchable, they're all pouring tens of billions of dollars into the same thing: AI infrastructure, data centers, chips, networking, power. It's the same playbook everywhere. Spend aggressively now, prove monetization later, which means the same fragility exists everywhere too. Because when you're priced for perfection, the market stops caring about good. It starts demanding better than expected every time. And the macro environment makes that demand even harsher.
When interest rates are low, investors can afford to be patient. They'll sit through long payoff timelines because there isn't a clean alternative. But when you can earn a meaningful return sitting in treasury bills, patience becomes expensive. So the tolerance for uncertainty shrinks. And in that kind of market, even tiny cracks in a high expectation story can trigger a very fast repricing, not just for Microsoft, but for every company running the same AI spending experiment. Here's the dirty secret that almost nobody says out loud. A lot of this AI spending isn't offensive, it's defensive. Microsoft isn't writing checks this big because they sat down, modeled the clean return on investment, and concluded the numbers are guaranteed to work. They're writing checks this big because not spending is an admission of weakness, and weakness gets punished even faster. If you don't build fast enough, AWS takes share, Google takes share, someone else takes the narrative, someone else wins the enterprise contracts. And once customers move, they don't casually move back. So the logic becomes simple: spend or get eaten. But here's the problem with arms races. If one company spends, they might gain an advantage. If everyone spends, the advantage disappears, and what's left is an industry drowning in capital intensity and competing on price. That's how returns get destroyed. You can win the race and still end up with worse economics than the business you started with. Now zoom in on the incentive structure, because that's where this becomes inevitable. Executives are rewarded for growth, scale, and stock performance. Boards want to protect a multi-trillion-dollar valuation. Institutions want a story that supports the multiple. So the safest move isn't always the most efficient move. The safest move is to look aggressive, to look like you're ahead, to spend like you can't lose. But optimizing for stock defense is not the same thing as optimizing for long-term ROI. And when the market finally decides it wants ROI instead of narrative, the repricing is violent. So what does this actually mean for you, for your portfolio? It means you have to separate two things that most people blend together. Microsoft, the business, is fine. The company is still growing. Azure is still a real engine. They're still generating enormous amounts of cash. Nothing about this report suggests Microsoft suddenly forgot how to operate.
But Microsoft, the stock, was priced like it was entitled to perfection. And that's the gap that matters, the gap between operational reality and market expectations. A business can perform well, and the stock can still get repriced brutally if the future it was priced for starts looking even slightly less certain. This sell-off wasn't the market saying Microsoft is a bad company. It was the market saying, at this price, that performance isn't enough. And once you understand that, you stop being surprised by days like this. Here's what you need to take away from this, and it's only 3 points. First, beating earnings doesn't save you if the trajectory disappoints. Microsoft cleared the estimates, but the market didn't care because the growth rate, the thing that supports the future story, showed signs of cooling. In markets, the direction matters more than the snapshot. Second, when a company is in heavy build mode, reported earnings become a distraction. Capex can be smoothed out on paper, but cash leaving the business is real. Free cash flow is where you see the cost of the strategy, and it's the number institutions respect because it can't be spun. Third, when a stock is priced for perfection, a tiny change in expectations can lead to a big change in the multiple, and multiple compression is ruthless. You don't need a disaster to lose hundreds of billions of dollars. You just need the market to decide it won't pay the same price for the same story anymore. So here's the test you have to run on yourself, honestly. Are you holding because at today's price, the fundamentals actually justify what you're paying? Or are you holding because it's been going up and you don't want to be the person who sold before it went higher? Those are not the same thesis. One is based on cash flow, valuation, and returns. The other is based on momentum and fear of missing out. And only one of them survives a day where a company can beat expectations and still get repriced like this. And to be clear, Microsoft will probably be fine over the long run. Satya Nadella is competent, Azure is real, the company is not falling apart. But a great business can still deliver mediocre returns for shareholders if the price you pay is too high. The stock can go sideways for a year or two while the company quietly grows into the expectations that were already baked in. That's the punchline. Quality doesn't protect you from valuation. So if you bought because you told yourself it's Microsoft, it only goes up, take this as the correction you needed. Stop confusing a good company with a good stock, because valuation always matters, eventually.